Yo, what's up, everybody? Wednesday, October 2nd. Hey, you like my shirt? Rambo. Yeah. All right, market down over 500 points. I told you, right? I told you way back last week. I told you the week before that. I told you all the way back in July. I told you in July. I told you in August. September 26th, we're going to see a market top. I can also tell you right now when the buy window will occur. You know what's funny? Like all of these sell-offs, there's always been a story, right? There's always been a narrative. I mean, for a long time, it was about the trade war, okay? And then it was about the inverted yield curve. Remember that? Inverted yield curve? And now it's about what? Trump impeachment? I don't know, whatever they come up with. But if that's the case, if it was about those things every single time, how did I know when the peaks and the troughs would occur? How did I know? I tell you this stuff in advance. And some of you have wised up. And you've come over to me and you have subscribed to MMT Trader, where I explain and I show and I forecast when these cycles are going to hit based on, yes, here it goes again for the millionth time, reserve flows. We're talking about the billions and billions, tens of billions, hundreds of billions, sometimes trillions that flow back and forth between the Treasury of the United States, the government, and the banking system. And this causes a reaction. Why does it cause a reaction? Because of the regulatory structure of the financial markets, particularly regulations that are imposed on the banks. They have to meet certain regulatory requirements. And reserves being bank assets, when there's a flood of them coming in and a flood of them going out, it causes adjustments. And when you're talking about banks collectively in the aggregate having over 17 trillion of reserves, even tiny adjustments in those reserves, 17 trillion in assets, even tiny adjustments in those assets cause market disruptions. So you got to know this. Like most of you out there, I would say most of you out there, you are completely ignorant of this. You are completely oblivious to this. And making matters worse, you don't want to educate yourself about this. You don't want to understand this. I mean, this is as close to having insider information. This is insider information, but it's totally legal. I mean, when I was a floor trader, and yes, for those of you who don't know, I was a member of 4 exchanges, the CME, the NYMEX, the COMEX, and the New York Futures Exchange. When I was a floor trader, you know, we did everything possible to try to figure out or to try to, you know, find out where the big brokers had their orders. You know, we would get friendly with these guys. We'd take them out to lunch, take them to the bar, buy them drinks, whatever we had to do to find out so that they would give us information about where their big orders were. So we could front run that stuff. It wasn't illegal. And that was just cha-ching, money right in the pocket. Now this is the same exact thing. You have the government moving billions and billions of dollars basically on a daily basis. You have the Fed doing the same thing, but you have to understand the effect. You have to understand the impact of these things. Otherwise, this is information that is worthless to you. And most of you, you would rather just stick to your lines on your charts, which tell you nothing other than what has happened in the past. And yes, there are going to be times, look, let's be honest about this business. What kind of a business is this? Like any other business, there are going to be times when positions are going to be challenging. There are going to be times when you are going to be called upon to have to wait because perhaps the fundamentals are correct, your reading of the fundamentals are correct, but for whatever reason, and it's usually zombie action, the markets are not working in your favor. You have to know how to manage such a situation. You don't bail out when things are correct. I mean, you have to be able to ride through it. If you know anything about sailing, and you're out there on the open seas and there is a storm, you basically have nowhere to go. You have to have the skills and the experience to ride that out. What's the old expression? Calm seas do not make for good sailors. Rough seas. In fact, you got to embrace those situations. You got to embrace those situations. There's no shortcuts, people. There's no shortcuts. I know a lot of you are, you want to find that magical system where there's going to be no discomfort and everything's going to be butterflies and rainbows and you're going to be making money all the time. Maybe once in a while you take a little tiny loss. Your beautifully, perfectly placed stop losses stop you out with a small loss. And then, of course, the next trade is going to be a gigantic profit because, right, that's the way it always works. Let's get back to the markets. By the way, last week on that gold sell-off, what was it, Friday or whatever, when we had a big sell-off, I said, and this was before we hit that point, I said 1467, 1465, that's the support level. It'll bounce back up. And I think we got that on Monday, and we're back over 1500. Now, I sent out another update today to tell my subscribers exactly what to do with that position. Longer term, gold is bullish. Let me just say this, the fundamentals, and I go back, this is not only based on policy. As you know, my original long position in gold, which I got into in December 2015, was based on the rate hikes by the Fed. That's inflationary. It was also based ongoing from that point. It was based on fiscal expansion, which has really, really accelerated, right? Who was the first one who told you that the government hit $1 trillion deficit? That was me. Every day in the news, it was reported like a week or two later. I get that information daily. I have that information daily. But aside from those factors, the monetary policy, which you can say now is kind of turned against gold, with the rate cuts again all over the world, and fiscal policy is still supportive. You have gold's own supply. Don't forget, gold is a commodity. It's an industrial metal. You have its own supply-demand fundamentals, and I've spoken about that. I'm not going to get into it, but longer term, those are still very bullish. All right. I sent out something on that today. I sent out an oil thing. Now, as you know, we've been long oil. We're still long oil. It ran up to 62. Some of us took profits. It came back down again. The last 3 weeks, by the way, yesterday's API inventory showed almost a 6 million barrel draw. Today's EIA report showed a 3.1 million barrel increase in inventory. So that is a huge disparity between those two things. That's 10 million barrel difference between those two things, a 5.95 draw and a 3.1 million, I'm sorry, that's not 10 million, but it's like what, 9 million between those two. So something is out of whack. And by the way, we saw for the first time in many, many weeks that U.S. domestic production is down 100,000 barrels a day. It dropped from 12 million barrels a day down to 11.9. Now, you know what cracks me up? Is that a few weeks back, or a month ago, we had that report that OPEC's production was up 50,000 barrels a day, and boy, they were selling like crazy, selling like crazy. Of course, what happened after that? Oil rallied, but they were selling on that 50,000, but it was still within their threshold of what their cuts are. But we have domestic production down 100,000 barrels a day, and OPEC output is down something like 1.6 million barrels a day since the Saudi thing. Nothing about that, right? No buying about that. So a lot of zombie selling. But we did see some weakness in oil exports, which is a little bit disconcerting, but I think that could be temporary. Anyway, what do? We're down 500. I call that. This is all based on monetary policy, which is bad. But at the same time, it's something the Fed had to do because it guided reserve balances down too low, basically got the system short. And reserves are concentrated now in just the large institutions, really. I mean, so we're seeing some weird behavior. That's how come they're having to do this stuff almost every day. But now we see the overnight lending rate basically in line with Fed targets. So hopefully by October 10th, that's when the term repos that the Fed did last week, that's when they're supposed to settle or unwind, and we could see a better environment there. But the real date may not be October 10th, and if you want to know what that real date is, you got to go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. See everybody tomorrow. Remember, I called this top, and I can tell you right now when the bottom is going to happen. Bye.